This talk is the ABC of finance, and we'll be covering everything you need to understand how fossil fuel projects are financed.
Hi, everybody. Welcome. Thank you for joining our webinar today. I haven't studied economics. I haven't had any work experience in the finance sector. And when I started my internship at Urgewald almost 10 years ago, I was simply interested in finance campaigning as a climate activist. So I learned finance along the job with the help of more experienced campaigners and scanning through Investopedia and the likes. And today I am honored and also very nervous to give a finance workshop to an activist crowd. I will tell you the basics we think are important to be an informed finance activist against fossil fuels. To give you a quick overview on what we're talking about, we'll touch briefly on insurances, then we'll have a look at two different types of loan groups which are important to understand. Then I will talk about how to raise money with bonds and shares, so investment, and finally I will explain the role of investment banks and asset managers. Insurances play a key role for new power projects because they are necessary already in an early stage of the process. You usually need already to get a building license, you need an insurance for the construction. Yeah, so the workers need to be insured the material. Also, maybe potential partners want an insurance. For example, they want to see that the board is insured against failure or legal cases before they come in. And finally, and very important, it is very tough to get a bank loan for a project that is not insured against delay or complete breakdown of the construction process. So insurances are actually crucial to lend money or to generate cash. I will not look further into insurance here, but more into why there's so much money necessary to build a coal power plant or any big coal project. Coal projects are expensive. Building a 600 megawatt coal-fired power plant costs around about $2 billion US. As a real-life example, the Alpha coal mine in Australia costed $4 billion US, and associated infrastructure, let's say, for example, rails, ports, and so on, costed for the Alpha mine $6 billion US. So we're talking about huge sums here. Every big infrastructure project is therefore mainly financed externally by debt. Only about a third of the financing will come from the company itself, so it's equity. One way to raise debt is by getting a loan. So here's an example of a company that is still getting corporate credits from most banks, though it's the biggest coal plant developer in the world. This is NTPC, India's national coal power company, and it's planning over 30 gigawatts of new coal-fired power in India, Bangladesh, and Mozambique. So as said, for them it will be very easy to get to receive some general corporate financing. So what's corporate financing? What we mean by that? It's, for example, general purpose loan, a credit line for working capital, and it's a preferred option for any company because the company can basically use the loan as it pleases for all purposes. The capital of the company is the security for the bank in that case. How would that work exactly? The company would go to its local bank. For NTPC, it would be the Bank of India. And then for a huge project, especially if it's internationally or for any global operating company, really, a local bank would always look for partners. So for example, they could look for Barclays. Barclays gave loans to NTPC in the past. Like that, the credit risk is spread between the banks, and that's why they do it. So for a big loan, for a big project, is always several banks involved you would need to look out for. So what is NTPC planning? Let's look at one example you might have heard about, which is Rampal coal power plant. It's at the rim of the Sundarbans mangrove forest, a World Heritage Site, means of survival for endemic species and for the population. The Sundarbans spread over India and Bangladesh. And you can see Rampal here on the chart. So let's say NTPC would not want to bear the financing risk. They wouldn't want to get a general loan, or maybe the general loan is not enough to finance the project. They could also apply for a loan dedicated to finance this particular project. Such a project loan bears a higher risk for the banks because there is no security from the corporation. The credit is paid back from the project's income only. Still, the banks want a sure proof of their credit being paid back, so they will examine the viability of the project following a strict protocol and still demand relatively high interest rates. So to sum up, a project loan is very hard to get. A general corporate loan is used much more often to finance big projects. We do regularly finance research on coal plant developers and other coal companies, and we had a look at the share of project-dedicated funding and general lending. And over the years, we found either only 5% or maximum up to 20% of all the lending was dedicated to a specific project. The major share is from general corporate purpose or working capital, also at least 80%. And therefore, I'm telling you all that because it's important that banks do not only stop financing coal projects, so exclude project finance, but also exclude financing for the companies which develop these coal projects. Nevertheless, many policies refer to dedicated financing of project lengths only. Up here you see over 30 commercial banks rule out project finance for new coal mines and or power plants. Let's say 30 and counting. It's going to be many more. But I just couldn't find the total number. Yeah, I'd reckon it's rather close to 40 by now. That's a good start for any bank to start excluding financing, but excluding coal companies needs to become the real state of the art. So far, 21 commercial banks rule out corporate finance for certain coal companies right now. Most UK banks still shy away from such a step. Alone, Royal Bank of Scotland has a first coal company exclusions that are already in place right now and not just a promise for the future. About half of the coal of the money provided by Western banks for coal power plants and such is coming from loans. But there is also another way to finance the project via issuing bonds and shares. So what does that exactly mean? Let's first have a look at shares, which you are more familiar with, some of you, I guess. And let's go back to our example of NTPC and Rampal, which is also called the Friendship Power Plant. Behind this Friendship plant is not only the Indian NTPC, as you saw, it's bordering India, this project, but it's situated in Bangladesh, and therefore the national power company, the Bangladesh Power Development Board, is a partner of NTPC. Together, they formed a so-called joint venture company. It's the Bangladesh India Friendship Power Company. Therefore, the power plant has its weird name also. And this joint venture was only set up to develop the Rampal project. One thing this joint venture can do is to generate cash for the project, for example, by emitting shares. If you emit shares, you get cash, and the buyers of the shares will expect to usually to get a dividend. However, these dividends are only paid if the balance sheet of the company allows that, of course. So shares is one possibility, but what we find for financing directly of a project is much more common is bonds. Issuing bonds basically means lending money from investors in exchange for a kind of debt certificate. What you see here on the picture is a bond of the German soccer club 1. FC Köln. A bond has a maturity date on which the debt is paid back, similar to a loan. Maturities of up to 30 years are very common, but it can be also 50 years or indefinite. Every half year or annually, an interest rate is paid to the bondholder. On the left side of the picture, you see like kind of receipts with place for a stamp. So here, if you're a bondholder of this soccer club, you would get a stamp there every time you get your interest payment. Yeah, so these bonds are really also a very old form of financing. Bonds can be traded like shares, but apart from that, these two financial instruments are very different from each other. While buying shares or stocks here means investing in the equity of the company, bonds means investing in its debt. In contrast to the dividend for a shareholder, the interest for bondholders will be paid for sure. It's guaranteed. Also, if a company goes bankrupt, bondholders are always served first before stockholders. On the other hand, having a share gives you some voting right in the company. This is not the case with a bond. A bond is really just an investment in the debt. It doesn't have to do with ownership of the company. So I think it's already time to take a look at some financial players providing the mentioned forms of financing I was talking about. So I will start with retail banks, corporate lenders, because this is the bank business you will be more familiar with. UK banks who are focusing on retail banking, I give two examples here. It's the Royal Bank of Scotland and Lloyds Banking Group. They manage your accounts, they might manage your savings or even your credit card, and they also do project and corporate lending. There's also another form of bank, the investment bank. So the three biggest UK banks are all investment banks. Can listen into individual webinars on all three of them, Barclays and HSBC tomorrow and Standard Chartered on Thursday. Investment banking means helping companies to raise money by selling shares or bonds for them. This is also known as underwriting. And just a sideline, do not mix that up with insurance's underwriting. They are similar in a way, but still mean something different. So what does underwriting of an investment, also if investment bank underwrites, what does that mean exactly? Let's start with the IPO. So when a share or bond is placed the first time on the market, this is called an initial public offering. This is the only moment where a company generates fresh cash from selling shares or bonds. Because when the emitted shares or bonds are traded further to a new owner, this does not generate direct cash to the company itself anymore. The traded assets can indirectly influence the cash flow of the company. For example, the share price has an impact on the credit ratings. Important to keep in mind here is, while a company issues shares usually only once, and it's also limited the amount of shares they can issue, obviously, because it's always meaning selling some equity of a company. A company can issue many different bonds. But in both cases, what is very likely to happen at the beginning, before such a public offering, is the company is looking for a bank or for several banks to advertise their assets. What then often follows is a so-called roadshow, where different potential investors are visited and the potential interest in the bonds or shares is raised and discussed to determine the amount of assets to be issued and also the price the cash that's gonna come in from it. Then happens the underwriting. That means the investment banks don't simply place the assets at the market, they underwrite the risk of selling these shares or bonds. They underwrite this risk by buying an agreed upon amount of shares for a fixed price. This is the usual way, at least, underwriting happens. Therefore, underwriting is really a way to directly finance a company or to indirectly finance the project the company is developing. For the bank, the underwriting is interesting because it can make real money with a transaction if the bank sells the company's shares or bonds quickly and for a higher price on the market. Yeah, this is the business model. That's what's in for the company at that place. So, as we understood underwriting now, who is actually buying these shares or bonds? For example, an asset manager could do that. Asset managers are basically investing other people's money. And as you see here with Aviva, you might know them, or I guess you do, insurance in UK, asset management is not only a business line of many banks, but also of quite a few insurance companies. The customers of asset managers are the asset owners. These are individuals with small or big wealth, companies, pension funds, or even state treasuries. The money of these asset owners can be invested in hand-picked companies, but any big asset owner will also invest in funds. Asset managers often lay out their own funds, but also offer public funds of competitors. So as fund is such a common investment as a way to invest money, what are funds exactly? An investment fund is a collective investment in a certain group of companies. The set of companies the fund is invested in can be from a certain geographical region, like one country, or from a special industry sector, or companies performing a certain way. The example I chose here is a fund that is replicating the Financial Times Stock Exchange Index, which means all the biggest 100 companies that are listed on the London Stock Exchange. Among them are familiar faces, BHP, Shell, the weapon producer BAE Systems, HSBC, or the Swiss mining giant Glencore. Funds are usually number one choice of individuals, maybe like us. imagine you want to have a bit of money, you don't want to leave it at the bank or under your bed, and you don't even want high interest rates, you just want it to be easily managed, because managing yourself the investment in several companies is lots of work, requires lots of knowledge. Hiring an investment manager is expensive. The fund seems a good option for, like, let's say, people like us. It bundles several companies and such reduces the risk of losing money when one company is failing. Also, transaction costs and management fees are lower because costs are split between many investors. And one reason why I'm introducing that here is that also the policies on funds asset managers layout is really important if you look at the policy of an asset manager. Yeah, it's important to keep in mind that call policies of asset managers usually only refer to their own assets. Yeah, assets they invest themselves for themselves, and not to the assets under management, the so-called third-party assets. They can say, we don't invest in coal, but the funds we sell to other people, they are all invested in coal. So that's really a nitty-gritty detail when looking at policies. And one of the few asset managers that applies its coal policy to third-party assets is the French insurance company AXA. So to recap, how does your money fuel the coal industry? Here an overview of the financial players I mentioned today and how they move your money into coal. The money you leave, for example, at a savings account at your bank can be used by the bank to finance their coal clients. In the end, your account's interest rate has to come from somewhere. Also, money you give an insurance or an asset manager is invested in bonds and shares of listed, for example, coal companies, but also, to make it a bit more complicated, also back into the banks, who then again, if it's a bond, can invest in the loan for a company. As a final slide, just to remember what Urgewald is doing. So our demand to all financial institutions is to divest from coal and all fossil fuels. And as you see here from the pictures of partners from us, from the US to Japan and from Australia to UK, people are protesting against fossil banks. So please join us, and thanks for listening in.
Thank you, Katrin. That was really fascinating. Thanks a lot for taking your time. We've got a good question here saying, sorry, just lost it here. As a private pension holder, can we vote to determine where our pension is invested, i.e. green sectors?
That really depends a bit on the scheme. So the only way to kind of make sure where your money goes into is if really you yourself invest money and put it to an asset manager, and it's somebody who you trust that they can do green investing or that they can lay out green funds. Usually pension funds have their own exclusion or non-exclusion policies. If it's your private pension, the best thing you can do is go to your pension insurance, I think, is it then in English? Sorry, I'm not sure. You would go there and ask them, like, how do you invest the money? Is there any transparency in the money? Because if it's not especially green or social institution, they are not aware that their clients would like green or social investing.
Okay, cool. And then Helen is asking if you could explain underwriting again, please.
Investment banking means placing a bond or share at the market, and underwriting the risk means basically you take a share of the risk away from the company, because the investment bank will buy an agreed upon set of shares for a certain price. So the company can be sure, okay, this amount of shares for this price we will get rid of. This is the cash we will get for sure. And then it's the risk of the bank to sell these shares on the market and to sell it for a price that they get a return which makes this deal profitable.
It was asked whether AXA's policies are any good, because you mentioned AXA.
On coal, yes, I would say on coal they're pretty good. I think the Nordic countries there is other good examples. But looking at the sheer size of AXA as an insurer and investor, this is AXA for us is really whom we put up as a good example for coal policy of an asset manager or insurance.
Just a question related to that Barry asked. how can we stop our money funding the fossil fuel industry? So you said already that AXA has quite a good policy on coal. And are there any other ways we can stop our money from funding that destructive industry?
There's of course several ways, and then maybe let's start with our own money. So one way, of course, would be to move your money to a green bank. However, that's not possible for everybody, depending on which location you're in. That's timely, costly. It's still a good option, but what you could start with is talk to your bank and ask the person you meet there at the bank account, like, where's my money invested in? Do you know that at all? Because people don't know. As we had that in the past here in Germany, going to local banks, and they don't know. They are actually scared by the question. So if many people ask their local banks where the money is invested in and tell them we don't want it into weapons or fossils, this is really a good start. The second thing is, of course, to, as I said, join us and try to get all financial institutions out of fossils. I think on concrete campaign ideas, I just don't want to elaborate too long on it, but the power of finance campaigning, so what you really can achieve, will my colleague Heffe tell you in the webinar right after. And on the last session on Friday, we also going to give you some examples in concrete campaigns we're doing, or our partners in the finance NGO world are doing.
Now the question is obviously, if we need to talk to our bank and maybe if we need to take our money out of that bank, how can we manage our money without funding that industry? And is there a list of asset management organizations and banks that have strong environmental credentials? Or is there any kind of list that tells you where or what good insurance companies are?
At the moment, it's really a bit different for the type of financial institution. So the network, which is looking into insurances in particular, and some of my colleagues are part of that, is Unfriend Coal, they call. So on the Unfriend Coal page, you can also see the ratings for coal exclusions from different insurance companies. So they can at least tell you who's the best in class. And then a list of good banks to invest in. I mean, I know we have that for Germany with our organization. I'm not sure of anything international. I'm also not aware of the green kind of finance world of UK, I have to admit. I know that Triodos Bank is a bank which is operating in several places in Europe.
I can actually say something about Triodos. So Triodos is in the UK. But apart from that, there's not really anything green that I personally am aware of. But there's a really good following up question. Which would you say are the best asset managers, banks or insurance companies when it comes to phasing out fossil fuel financing? And which are the worst? Also, which countries are most or least progressive on that?
It's a broad question. I can answer pieces of it, I guess. So when you look at regions, who's really like leading is the Nordic countries and France when it comes on exclusions. So next to AXA as an insurance, also German Allianz has some things in place. I think they're not so bad on that, but as I'm campaigning against them, I cannot say too much good about them. But they're not as far as AXA, but they did quite a bit. They got quite a bit of pressure and moved. But of course, that's also a giant. Yeah, I don't know if people here on the call really want to have their insurance as one of these giant companies. And also to say here, big difference to AXA is that Allianz is not applying this to third parties, their policies, and they're actually a huge asset manager because they own PIMCO and US asset managers. So here again, for own assets, Allianz is good, for others it's not. Then the Nordic countries, also for banks, I think really state of the art here, or like the leading is Crédit Agricole and Crédit Mutuel. So the French banks, they have really good call policies whom they're applying now. So see how good that works. Worst of the worst, if you look at size, of course in the US, JP Morgan Chase is a bank and BlackRock as an asset manager. And in the UK, I'd say it's Barclays, and Nicole is going to tell you more about that tomorrow. They are the biggest fossil fuel company in Europe, biggest fossil fuel bank, I'm sorry, in Europe.
we just had someone saying something about how you can best influence company, or how you can influence banks or asset managers in a good way. And that person, just looking up the name, Paul, he said that he works for an asset manager, and that the reason why that asset manager is actually looking into sustainable investment is now because people from within the company are now pressuring or putting pressure on the board. And that's a really good point I think we should also make.
If your aim when campaigning is not the finance world as a whole, yeah, but it's really more like how banks are working, then you can definitely have a win, like talking to the people working there. Some they are also not aware what the money of the bank is doing, and when they hear about it, they're shocked. And we from the German campaigns we do here, we have people in the banks who tell us what they think is great, and there are sometimes people who give us information also because they think it's great what we're doing and they want their employer to become better. There's somebody mentioning here the Co-op and the Smile Bank. Don't know if you know them, but it seems to be UK green banks.
I looked into Co-op a few months ago when I was myself trying to figure out where to best move my money to. And Co-op is quite good, but it's still like I personally do not know of any exclusion criteria they have. I just know that their structure is, so they are structured in a way that they are less likely to invest a lot of money into fossil fuels. But they're definitely not, safe to say, a green bank. They're just better than the worst banks in the UK. So if you're looking to move your money out of a very, very dirty bank in the UK, Co-op would be an alternative. But I cannot guarantee you that it's a green bank personally. And Smile Bank, I personally have never heard of before. I'm just looking if there's any more questions.
There's one. Does divestment from fossil fuels mean moving away from shares and bonds, or does it include loans also, from Johnny? So we use it as a whole. As when we talk about divest, especially as a slogan, we mean cut all financial ties to these institutions, be it in insurance, underwriting, loans, or whatever kind of service and support you could give as a financial institution to these companies.
And then there's another question asking, where does money from health insurance go?
In the end, yeah, the health insurance can invest in death, in weapon companies, in fossil fuel companies. It's really crazy, but that's the way it is. So they have their own money, of course, but also the money they get, they have to put it somewhere. They're also not going to put it just in a safe somewhere to wait there, but they want it to work, to generate more money, also to pay you out if you need the insurance to be paid out at some point. And because that is so crazy, I think is one reason why the Unfriend Call campaign, so the campaign which is working on insurances, is quite successful. Because it's mind-blowing. Yeah, you have insurance companies which insure against climate risk and invest in NTPC, and so it's very easy to make that point. Also, yeah.
If there's any more questions you have, you can always go to the Urgewald website, which is urgewald.org. Thank you so much, Katrin, for taking your time in home office. I know it's a stressful time for you.
I'm not going to complain. It's all good.
Thanks, everybody, for joining us.